Good morning and welcome to Sara's Opening Bell. I'm your host, Sara Bryant. Thanks for tuning in. So the world lost one of the investor greats last week. On Tuesday, November 28th, Charlie Munger, vice chairman of Berkshire Hathaway and Warren Buffett's longtime friend and business partner, passed away at age 99. Buffett himself credits Munger for pushing him to expand his investment strategy. Warren Buffett is still considered one of the most successful investors of all time, and his company, Berkshire Hathaway, is one of the most successful. From 1965 to 2022, Berkshire Hathaway stock outperformed the S&P 500 index annually with a 19.8% return, compared to the S&P 500's 9.9% return during that same period. So it's of no surprise that many investors look to mirror Munger and Buffett's investment approach. Warren Buffett, though known as both a savvy businessman and a generous philanthropist, is probably best known for being one of the world's most successful investors. Buffett follows an investment philosophy called value investing. So a value investor searches for businesses that are trading at a share price that's considered a bargain or undervalued, or stocks that aren't recognized by a majority of other buyers. Now, our friends over at Fidelity described it perfectly. It's like finding that diamond in the rough. So stocks can become undervalued for many reasons. In some cases, public perception will push the price down, such as if a major figure in the company is caught in a personal scandal or the company does something unethical. But if the company's financials are still relatively solid, value seekers may see this as an opportunity to invest because they figure that the public will soon forget about whatever happened and the price will rise to where it should be. Value investors tend to look for specific criteria, such as low PE ratios, high dividends, and slow and steady profits. And they buy stock in these companies because they believe that they are likely to turn a profit in the future because at their core, they're still fundamentally strong. Another common approach to investing is growth investing. Growth investors buy stock in companies that are expanding rapidly and have or will soon have really strong profits. Growth stocks tend to be a bit more expensive and priced higher than the overall market. They're a bit of a riskier investment and typically offer little to no dividend payments. But the reward is worth the risk to growth investors because these companies might have a new product or a unique business model that's disrupting an existing industry, and investors are expecting big gains. Growth here is the priority. And typically in companies like these, you'll find that they are reinvesting earnings in themselves in order to expand, whether in the form of new employees, new equipment, or through acquisitions. That said, every investor has their own particular preferred approach and criteria. And in terms of returns, growth and value investing are pretty evenly matched. One approach may show better returns for a few years, but inevitably the other approach will pull ahead and go through a period of stronger returns. So instead of only investing according to one style, you may opt to diversify by holding a bit of both. That can give you a mix of different types of companies in a variety of industries, and it means that you don't have to worry about which approach is in or out of favor. So we're wrapping up the fall semester of the stock market game session. And as you reflect and evaluate your investment choices, would you say you were more of a growth or a value investor? Take the time to review your own investing habits because it may inform your future approach. And there's no better time than the present because markets are now open.